Well, welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Corporate venture capital is an existing business utilizing venture funding to further the company's strategic objectives. The firm takes an equity stake in startups either through an internal fund or off the corporate balance sheet. Unlike traditional venture capital, corporate VCs look to gain a competitive advantage for the company and not a financial return. The firm seeks to grow their business and uses an investment into a startup to gain knowledge of an emerging market, identify key players in the industry, and potentially use the results to grow sales. These initial investments often lead to a buyout of the startup. The investment is a useful tool for diligencing a startup and influencing its direction. There are some corporate VCs investing for a return on investment rather than strategic initiatives, but this is rare. Most corporate VCs make investments with the goal of winning more business for their current product and services. It's a useful method for exploring new markets without committing substantial resources from the corporation. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start us something today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.